Welcome back. This is episode 132. In this week's episode, I want to have some fun and make 6 predictions for the markets for 2023. And I'm sure along your years of studying and following the markets, you've seen and read other analyst predictions, financial advisors' predictions for the markets, and I thought I'd give my shot at making some market predictions. And we'll be able to go back a year from now, review these predictions, see how accurate they are. And as you know, with any prediction, this is a prediction. And these are not investment recommendations. And you should definitely consider your own personal financial situation before acting on any of these recommendations, if at all. And I still firmly believe in the core investment principles that I preach for my clients, which is having a diversified portfolio, using asset allocation, and staying invested in the market. But let's have some fun and tackle some of these market predictions. So we'll start with probably one of the easiest ones, and that would be the predicted return for the S&P 500. And as you probably know, the S&P 500 are the 500 largest stocks in the U.S., and there's different ways that you can track it, and you can invest in a mutual fund, an index fund. So if we look at just the S&P 500 index itself, it declined 19.4% last year. And historically, the average decline of the S&P 500 since 1927, which is where a lot of the data comes from, which is 96 years, it has declined 32 times in the last 96 years. So about 1/3 of the time, so 1 every 3 years is a decline, and the average decline has been 14%. So if we look at last year's decline, it was a little bit worse than average, but it certainly wasn't the worst. There's been many years where the S&P 500 has declined at a much greater percentage. And if we then look at how often declines are followed by additional years of declines, that very rarely happens. And it's only happened, I believe, 10 times where one year there's been a negative return and the following year has also been a negative return. So the odds are relatively low of that happening, 1 of every 9. And the last time it happened was during the dot-com bubble bursting, where you had a negative year in 2000, 2001, and 2002. So that cumulative return was down about 44%. So it was a rather large decline. So that brings me to my prediction for 2023, my prediction for the S&P 500. So if you look at where the S&P 500 ended the year versus where it began the year, I believe the market will get back above where it declined from the previous year and make about 3% above that. So if you look at that as compared to where we are, that would be the S&P 500 ending at a value of 49.81, which is a 28% increase. So you might be thinking, wow, you've kind of lost your mind here, Ryan. But again, this is a prediction. And we look at the past years or the history of the S&P 500. When you have a negative return, the following year isn't just like a +5 or a +6. It's very large numbers, usually double digit, and many of those numbers 20% plus. So that's my prediction for the S&P 500, 28% increase in 2023. The next area I want to focus on is whether growth or value stocks are going to outperform in 2023. And if you're not familiar, growth stocks are companies that are growing their earnings, usually have a high price to earnings multiple, whereas, and generally these are more of your technology companies, sometimes your biotech companies, where value stocks are more established companies that trade at a discount to the market. And these will be maybe your consumer staples and your more blue chip companies. And since 1927, value stocks have outperformed growth stocks by a margin of about 4% per year. However, in the last 12 years, growth stocks have outperformed value 8 out of 12 years, and both have done very well, with value gaining 128% over that time frame. If you're measuring it by the Russell 1000 value, that's an index of value stocks. There are 1,000 stocks in the index, and you could buy a mutual fund or an index fund that invests in them. whereas the Russell 1000 growth gained 177%. And a lot of that has obviously been attributed to certain sector of that market, sometimes called the FANG stocks, which was originally 4 stocks, Facebook, Apple, Netflix, and Google. And then it was increased to 5, which is Facebook, Amazon, Apple, Netflix, and Google. So this past year, value did much better than growth, where the Russell 1000 value only declined 7.65% this past year, whereas growth declined 29%. And as I mentioned earlier, a lot of that was due to the FANG stocks taking a massive beating, where some of these, like Facebook was down 65%. A non-FANG stock that's part of the Russell 1000 growth is Tesla, down 69%. So there's some major declines, and a lot of these stocks are now below the levels where they were going into pre-COVID, which is where you saw a lot of the growth in growth stocks because we were all working from home. We're using a lot more technology. So that brings me to my prediction. Growth or value? I am favoring growth. I believe that growth, despite outperforming for a relatively long period of time, will actually outperform value, because I think things have gotten way oversold, and the recession, that we'll have most likely in 2023 won't be as bad as predicted. So that leads me to prediction number 3, large cap stocks or small cap stocks. So you can further categorize stocks based off the size of the company. And that's called its market capitalization. And that very simply is the number of shares of a company times the share price gives you a value. And large companies have a value of 10 billion or more, where small companies generally have a valuation of 2 billion or less. And the reason I mention this is because just like growth and value, you can also, when you look at these two categories of stocks, you can see very big differences in performance. And the most commonly measured index for large cap stocks is the S&P 500, and the most commonly measured index for small cap stocks is the Russell 2000. So if you look at these indexes and you go underneath the hood a little bit and you see what actually makes up the sector breakdown, because these indexes invest across all sectors, but you'll see that large cap stocks, when compared to small cap, tend to favor technology and consumer staples, where small cap tends to be weighted more towards healthcare, financials, and industrials. So this would then make small caps more cyclical, meaning they're going to move around a lot more than large cap, because healthcare, financial, and industrial is definitely more cyclical. People do more banking when things are good. Banks make more money. Industrial, right? There's more building going on. There's more heavy machinery being bought, manufactured when the economy is going well. So during COVID-19, small cap stocks declined 41% and large cap declined 34%. But over the next 12 months, large caps increased 76%, but small caps increased 126%. So you made a lot more money coming out of COVID-19 if you were invested in small cap or your portfolio was weighted towards them. And then if you compare these two indexes over the last 12 years, large cap has outperformed small cap in 8 of 12 years. The total return for large cap has been 155%, and small cap has lagged at 116%. So I believe that small cap will outperform large cap for the next year. I believe that we'll historically, I should mention too, that small cap has actually outperformed large cap over the long term by about an average of 1% per year. It doesn't come without the additional risk, as we saw during COVID. Small caps declined larger than large caps during that decline, and that's generally how things go. But I still think this next year that small caps will have a good year and will outperform large cap, being that I think things are a little oversold and we're not going to see as big of a recession as everyone's predicting. So this brings me to prediction number 4, Bitcoin or gold. So this is not maybe something you're thinking about investing. And as you know, I've talked in past episodes, I'm not a big fan of Bitcoin. It has a lot of issues. It's difficult for retirees to invest in. It's very speculative, very volatile. But why you might be thinking about gold or Bitcoin is that why you would invest in one of these assets is that you want to give yourself a hedge against a hedge as a non-correlated asset. And what does that mean? Well, most people are invested in stocks and bonds, so you're looking for something else that you can invest in that if stocks and bonds are going down in value, you can actually have another asset class that can hold its own. So historically, it's been gold, and in recent years, some people have been suggesting that maybe it should be Bitcoin. But maybe you're not aware, but Bitcoin had its worst year ever in 2022, declining 81%. So whereas gold declined 3.21%. It's certainly not what the people that are big fans of gold, sometimes called gold bugs, were hoping for. Anytime you see a declining stock market, people that are very heavily invested in gold are hoping that gold is actually going to make you money. It lost a lot less than the S&P 500, but it still lost money. So really gold in recent times has not been a very good hedge against the declining stock market. And, Bitcoin has also had a major sell-off in the last year, down 83%. But despite that, if you look over the last 12 years, you invested in Bitcoin 12 years ago, you're going to be super happy, especially if you didn't sell any of your Bitcoins. Your return would have been 7,730%. So phenomenal return. But unfortunately, very few of us did that. And it's really been more people that have been investing in Bitcoin lately that have been part of these major sell-offs. So you definitely have to proceed with caution with Bitcoin. But because there's been such a large sell-off in Bitcoin of 81%, and gold has really disappointed in recent years as far as being a good hedge against the market decline, I think that Bitcoin is actually going to outperform gold in the next year. So this brings me to prediction area number 5, and this would be either domestic stocks or international stocks. And this is another way that you can dice up your portfolio. Are you going to be invested in U.S. markets? Or are you going to be invested in foreign markets? A little bit of both. And what I compared here was the U.S. markets as measured by the S&P 500 compared to all other markets across outside of the U.S., which is estimated that about 60% of all companies you could invest in are actually listed on exchanges outside of the U.S. So that's really the main reason why people invest in international stocks, because it's giving you a greater diversification, greater exposure. However, if you were to look at the performance in recent years, you probably won't be thrilled if you have been investing in international stocks. So I compared two funds, the State Street Spider World XUS ETF, which symbol is SPDW, versus State Street's S&P 500 ETF, which is SPLG. And so what you'll find is that for the Spider State Street, or SPDW, I should say, they're the XUS ETF, has underperformed SPLG, the S&P 500, the US ETF, significantly. 9 of the last 12 years, the S&P 500, the US market, has outperformed the foreign market. And the return over that 12-year period, the S&P 500, SPLG, has returned 155%, and SPDW has only returned 61%. So you're seeing a pretty big difference. And if you look at research about international markets, you'll see that this has been a long-term trend going on a number of years. A lot of people believe that maybe that trend is starting to come to an end. If you look at last year, the international markets slightly outperformed the U.S. markets. SPDW had a negative return of 16%, and SPLG had a negative return of 18%. So it's still negative, but it outperformed by a couple percent. But my prediction, I still think that the U.S. market, SPLG, is going to outperform the international market for the next year. I think there's too many problems across the globe that are going to impact Europe, especially the war in Ukraine. And so I think that, I'm going to give the edge to the U.S. For the next year. So this leads me to my final area I'm going to make a prediction on, and this would be interest rates as measured by the federal funds rate. And the federal funds rate is the way that our U.S. Federal Reserve controls our banking system. They change the interest rate that they charge banks to borrow money. So if you've been following along last year, you know that one of the largest increases that's ever occurred with our Federal Reserve. They raised rates from almost zero at 0.25% to roughly 4.5%. And that's had a lot of disruptive effects in our market. And it's been predicted that the Fed will raise rates a few more times. And I'm predicting they'll raise rates twice more this year. They'll do a 0.5% raise and then a 0.25% raise, and we'll end the year at 5.25%. And so they'll hold at this rate, and there won't be any further rate cuts in 2023. I think the Fed will get it wrong again. They probably got it wrong at the beginning. They should have raised rates a lot more aggressively in the past, in 2021, maybe even towards the end of 2020. And they sat too long, and that's why they had to raise rates so aggressively. And they've really made a mess of the mortgage market, because if you're trying to get a mortgage now, you're paying a high rate. And but I don't think they're gonna lower rates this year. I think we're really waiting until 2024 until they'll start lowering rates. So if you're a borrower, this is not going to be great for you, because you're probably going to be paying higher rates. But if you're a saver, it's a good time to be looking at where you're keeping your money. If you have a lot of money in your bank and not paying you any interest, definitely go back and listen to episode 116, the 7 best short-term investments to grow your money, and take some action there. So I hope you found these predictions entertaining. I definitely enjoyed putting them together. And I look forward to checking in on this next year to see, how accurate I am. What's my batting average for my predictions. If you have a listener question you'd like to have considered for a future episode, please go to retirewithryan.com to submit your listener question. Have a great week, and I look forward to talking to you next Wednesday. Take care.